Hello and welcome to Morning Brief Market Sunrise. I'm Allie Canal, live from Yahoo Finance's studios in New York City. It's Thursday, October 30th. Coming up on the show, President Trump calls his meeting with China's Xi Jinping amazing, announcing he'll cut fentanyl-related tariffs in half as the two countries attempt a broader reset that also includes rare earth exports and soybean deals. But Beijing's readout left out key details, including any mention of semiconductors. We'll break down what that means for both tech and trade. Plus, investors still digesting results from Alphabet, Meta, and Microsoft. Plus, Reuters reporting that OpenAI is laying the groundwork for a $1 trillion IPO. This comes as Apple and Amazon gear up to report after the bell today, capping off a massive week for big tech earnings. And the Fed cut interest rates once again, but another move in December isn't a done deal as officials weigh sticky inflation against a cooling job market. We have lots to get into, so grab your coffee and let's own the morning. Markets are set for a mixed open. We're seeing Dow futures down around 100 points, while the S&P 500 and NASDAQ are hovering lower near the flat line, but pretty much to the downside at this point, indicating an open that will be lower across the board. Investors are waiting and watching to see if that more optimistic between U.S. and China can give stocks a bit of a boost, especially after Wednesday's decline following Jerome Powell's more cautious comments on future Fed rate cuts. And there's plenty more driving the agenda this morning. So let's get to the three things that you need to know, starting with that U.S.-China meeting. President Trump calling his face-to-face with China's Xi Jinping amazing after the two leaders met in South Korea, their first in-person meeting of Trump's second term. Trump did announce that he'll cut a 20% tariff on Chinese goods linked to fentanyl to 10%, part of what's been described as a reset in trade relations. The deal also includes China extending rare earth exports for at least another year and renewing purchases of U.S. soybeans. That would be a big boost for American farmers. The president framed it as a win for both sides, saying a formal agreement could be signed pretty soon. But talks over NVIDIA's access to China were left out, Trump saying that Beijing and the chipmaker will work that out themselves, adding we're not talking about the Blackwell. Also still unresolved, the future of TikTok and China's ties to Russia, with Trump saying the two sides agreed to work together on Ukraine. Plus, investors continue to digest earnings from Alphabet, Meta, and Microsoft, with AI spending still front and center. But we are seeing two very different reactions here. Alphabet shares jumping over 7% in pre-market trading, while Meta is sliding nearly 9%. We'll break down why throughout the show. Meanwhile, Reuters reporting that ChatGPT maker OpenAI is laying the groundwork for a $1 trillion IPO as the AI boom shows no signs of slowing down. This coming after the company formalized its new public benefit structure this week. And finally, central banks in focus this morning. The Fed cut interest rates by another quarter point, but it wasn't a unanimous decision. Two officials dissented on either side of the move, and Chair Powell struck a cautious tone, saying that future rate cuts are not guaranteed. Overseas, the Bank of Japan held steady overnight, while the European Central Bank meets later today, with markets expecting a similar outcome. But let's dive deeper into that meeting between the U.S. and China. Joining us now, Yahoo Finance Washington correspondent Ben Worschel. Ben, thank you so much for being here. You've been following this meeting very closely. How significant is this reset when we think about the future of U.S.-China trade?
Yeah, I think the way to think about this morning, Allie, the way to think about this is as a temporary truce. This is a lot of the details we know about this so far, which aren't fulsome yet, are with expiration dates, which I think is important for markets to understand. China agreed to step back on its rare earth mineral export controls for 1 year. There's a lessening of shipping fees for 1 year. China is talking about increasing soybean purchases, but what we've seen this year is that they can cut that off anytime they want to. The one thing that I think is fair to describe as a shift is this tariff news. It was about a week ago this time that Trump was talking about adding 100% tariff tariffs on China. As you mentioned, what we've seen in this agreement is a 10% decrease. So that is clearly a directional arrow in the direction of de-escalation. But I would note that the overall top line still on China tariffs at the moment is 47%. So these are still really significant tariffs, most of which Trump has imposed since he took office. So there's clearly a lot more talk to happen on tariffs, even as that appears to be moving in the right direction from a market's perspective.
Right, a lot more talk on tariffs, and there was a lack of clarity when it comes to some things that were left off the table, from semiconductors to geopolitics. So where did the U.S. come up short, maybe, or at least did not get enough clarity on from Beijing?
Yeah, one of the things aspects of this is when you put the kind of list of things that were agreed to and the things that weren't agreed to in this meeting, the weren't agreed to list is clearly longer here. Trump said Taiwan never came up. He talked about how there's not a lot he can do on the issue of China's purchases of Russian oil. Also not finalized, which we expected to be finalized, was TikTok. This is the deal that's pending to spin off their operations and keep it all open in the U.S. That's apparently still hung up, according to the Chinese Commerce Ministry. And then there's the big non-movement you mentioned on semiconductors. This was a bit of a surprise after a lot of expectations this week that semiconductors would be kind of more fulsomely on the table, especially after Trump crossed paths with the NVIDIA CEO just yesterday. On the ride home after this meeting, his tone, I think, is noticeably different. He just kind of described the U.S. as not involved directly in this U.S. semiconductors in China issue. He talked about mediating talks, but said it was kind of between those two sides. So that's a real shift here, and shows kind of how thorny this semiconductor issue is, no matter how much China wants it to happen.
And Ben, futures are lower after these headlines crossing. How is the trade world reacting to this meeting here?
Yeah, I think the one lesson you can take from the initial trade world reaction so far is to know that this is a positive. This is a clear de-escalation. This kind of takes sort of some U.S.-China turbulence off the table for the coming months, but you shouldn't overstate this in the overall thing. So good short term, but the underlying U.S.-China relationship doesn't appear to be super changed. Capital Economics this morning offered a sense of this perspective. They said the kind of overall picture, there's good short term, but the overall picture is that both sides will continue to purchase their decoupling. So in other words, the direction of the U.S. and China apart from each other isn't going to change likely from this. Terry Haynes of Pangea Policy, who's another friend of the show that's smart on this, talked about how nobody should expect much more than what he calls nebulous truces for any short period of time. So this is clearly going to be a positive for the relationship in the short term. We're taking some of these issues off the table for a few months, but the underlying issues are not going away anytime soon.
And finally, Ben, real quickly, this is all happening as the U.S. government is still shut down. Is there any progress when it comes to potentially ending this shutdown?
Yeah, so you have to squint. Yeah, we're a month into this shutdown. Where this weekend will be 1 month, and by this time next week it'll be the longest shutdown in history. But there is a few signs of at least talking about having talks in kind of the way Washington works here. Punchbowl News is a good chronicler of all this, and the way to describe it is a faint pulse of talks. So I wouldn't overstate it, but there is something going on here. For one thing, we've seen new energy towards bipartisan work on appropriations. This is important because if there can be movement there, it's sort of movement overall, but it can also make this from a full shutdown into a partial shutdown. Senate Majority Leader John Thune has also kind of floated the idea of more fulsome talks to end the shutdown. He's talked about how lower level talks are going on and said he might join talks pretty soon. So it's all kind of a 10-step process perhaps to end the shutdown, but there is at least a little bit of signs that we're on step 1 or 2, but clearly a long ways to go. The Senate is scheduled to have some more votes today and then head home for the weekend. So this isn't a sort of happening soon, the expectation is, but there could be kind of signs towards this next week as we enter record territory.
All right, Ben, thank you so much. A lot of things going on in Washington that's keeping you very busy. Appreciate it. Turning now to tech. It's been a big week for earnings, and we're seeing some major moves in pre-market trading. Meta shares are down about 8% after the company reported strong revenue but missed on earnings, hit by a one-time tax charge and heavy AI spending. The social media giant is laying out tens of billions to build data centers and hire talent, raising its 2025 capital spending outlook to as much as $72 billion. Meta says that number will climb even higher in 2026 as infrastructure and compensation costs surge. Next up, Microsoft shares also moving lower this morning, down roughly 3% pre-market, even after topping expectations on both revenue and earnings. Its cloud business grew 26% year over year, but capital expenditures jumped 74% to $35 billion, mostly to fund AI infrastructure. That comes as Microsoft finalized a new deal with OpenAI, which has restructured into a for-profit public benefit corporation, with Microsoft holding a 27% stake worth roughly $135 billion. Meanwhile, Google parent Alphabet is moving in the opposite direction here. Shares are up more than 7% after a strong quarter that topped Wall Street's expectations. Revenue climbed to $102 billion, driven by a 34% jump in Google Cloud, where AI deals generated billions of dollars in new revenue. Alphabet also raised its full-year CapEx forecast to $92 billion, citing heavy AI demand. And staying with the AI theme, Reuters reporting that OpenAI is laying the groundwork for a possible $1 trillion IPO that would make it one of the biggest public offerings in history. The move comes after the company completed a major restructuring that gives its nonprofit arm a 26% stake, while Microsoft holds about 27%. An IPO would open the door to more capital and could help fund CEO Sam Altman's ambitious plans to pour trillions into AI. Well, coming up, we'll have more reaction to the Fed's rate move and what Chair Powell had to say in the post-decision press conference. You're watching Market Sunrise. Stay tuned. Welcome back to Market Sunrise. The Federal Reserve in focus this morning after the central bank cut rates by 25 basis points in a split decision and also signaled that a December cut is not a done deal. Fed Chair Jerome Powell struck a careful tone in his presser, saying policy is, quote, not on a preset course. Yahoo Finance's Jennifer Schonberger was in D.C. for the decision and broke down the key takeaways from Powell's presser. Take a listen.
Fed Chair Jay Powell clearly pulling back market expectations for a rate cut in December, saying that it was not a foregone conclusion. And he sort of slipped up towards the end of the press conference, saying, if we cut again, and then sort of caught himself and walked that back again. Take a listen to what he had to say.
There were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
He characterized the rate cut today and last time both as a risk management move, but said that may not be the case going forward. He says the Fed has cut twice now and that we are now 150 basis points closer to neutral than we were a year ago. And so that perhaps, quote, there is a growing chorus of maybe we should wait a cycle. So more hesitation there. Interestingly, I noticed that Chair Powell was not all that worried about the state of the job market, given the layoff announcements that we've seen this week from major companies. He said that they've been looking at the state level unemployment claims, and those have remained stable. And so while we are seeing bits and pieces of layoffs here and there, he says it's not showing up in the aggregate data right now. He seems to be more concerned about the supply side than the labor side. He thinks it's really immigration that's weighing on the supply of workers and bringing down the strength of the labor market. So that was an interesting point there. And he also talked about equity valuations. He says that it's not an overly troubling picture, and he painted a different picture of now versus the 1990s. He said this is not the go-go 90s bubble because back then companies were just more about ideas. Today, companies are actually trading on real earnings growth and that they have actual business models. And he said that effective December 1st, they will freeze the size of the balance sheet. And the reason that they opted to do December 1st was to give markets a bit of time. However, as we go into next year, there is a chance that the Fed could begin buying some more treasuries, more on the shorter end of the curve, to keep the balance sheet stable and align more with what we're seeing as far as issuance from the Treasury.
Now time for some of the trending tickers in the show today. We are taking a look at a variety of names that are moving. Let's start with Boeing and Airbus. It's a tale of two plane makers, and the divide just keeps deepening here. Airbus is up sharply after reporting earnings last night, while Boeing is suffering, still in the red, even after it closed down yesterday. Now Boeing is taking a nearly $5 billion charge linked to delays in its 777X jet program, but there's also some good news. CEO Kelly Ortberg pointed out that new milestones have been achieved, including positive cash flow. Meanwhile, Airbus is navigating its own issues. For instance, it's still struggling to keep up with demand due to various delays in its supply chains, particularly with engines. But Airbus confirmed its ambitious financial targets for the year and posted some strong numbers, with net profit increasing 14% to 1.12 billion euros. Now, some investors are also bullish on the positive impact of a trade deal between the U.S. and Europe, and Airbus projects to co-create a new entity to compete with Elon Musk's SpaceX, also boosting optimism there. Now, the good news for both aviation giants is that their order backlogs do remain high. Next up, let's take a look at shares of Chipotle. The stock of the Mexican grill chain plunged about 19% overnight after the company lowered its full-year projection on traffic in its restaurants. Analysts saying that Chipotle's premium is clearly at risk if the company doesn't find a way to reignite growth. Specifically, Chipotle's Q3 revenue came in around $3 billion versus estimates of around $3.05 billion, and high costs also weighed on margins. One thought to highlight here: when even a market darling like Chipotle is showing cracks, it's probably telling us something broader about consumer spending and margin pressure in the overall sector. That seems to be what investors are thinking as Chipotle's peers are also down. You're seeing shares of Kava Group, Shake Shack, and Wingstop all in the red early this morning. And now let's talk about chips, the semiconductor type, of course. South Korea's Samsung Electronics is posting strong gains today. The company's semiconductor business posted an operating profit of around $4.9 billion in Q3. That's up around 80% year over year, driven by strong global demand for memory chips and accelerated by AI server demand. So put simply here, the rising tide in AI and data processing capabilities is growing and leading to some big winners on top of NVIDIA. NVIDIA did make history this week by reaching an incredible $5 trillion market cap. It is now slightly down in pre-market. We'll see when Wall Street opens whether it can stay above that $5 trillion market cap. It will depend mostly on how investors interpret the outcome of trade talks between President Trump and China's Xi Jinping, who, remember, didn't end up talking about NVIDIA's Blackwell chips. And staying with the Mag 7 trade here, 5 of those tech giants are and have reported within just 36 hours of each other. Apple and Amazon set to round out the week later today. And the amount of money that's flowing across those stocks is staggering. Alphabet up around 8% now. Meta down more than 8% in pre-market trade. Alphabet, the clear winner so far, delivering strong results that show its AI bets are paying off thanks to a big boost from advertising revenue. And that's been a tougher story for Microsoft and even more so Meta, where massive AI spending is weighing on profits. Aaron Kessler, analyst at Seaport Research Partners, broke down Meta's results right here on Yahoo Finance with my colleague Josh Lipton. Take a listen.
The expenses up a little bit, both on operating expense guidance for the remainder of the year, as well as the CapEx slightly increased as well. So that might be concerning for investors that may want to see some rationalization on the expense base. And so we'll have to look on the call for more disclosures there. But top line was strong. I would say they beat on the revenues for the quarter, ad revenues. The guidance for the quarter for Q4 also relatively strong, although largely in line with street expectations. But I would say revenue is good, maybe some noise around some of the expense issues as well as the tax hit.
They are seeing that full year CapEx, just to put a number on there, and it looks like they're calling now for between 70 to 72 billion. Is that roughly what you had penciled in?
Yeah, it wasn't far off. I believe last quarter it was 66 to 72, so a slight increase at the kind of the mid to high end of that range versus previously. I think investors want to hear on the call, though, in terms of kind of what this CapEx is going to be used for. They talked about potentially cutting some of the expenses around AI in terms of headcount. I think investors are still want to see what the ROI is on some of this CapEx spend. It's a little bit less clear for Meta. versus an Amazon or a Google who's really spending that CapEx on cloud given the strong demand those companies are seeing.
Some bulls come on, Aaron, and they said, listen, the CapEx spend makes sense to them because they say, well, we see where AI is having an impact in this name. You know, we see it in the user engagement, we see it in the ad business. Do you see that?
Definitely for the core business, we do think it makes a lot of sense continuing to spend CapEx and AI for the core business. I think our point is on the non-core business, the super intelligence investments, less clear how they're going to monetize that at this point. It's obviously a multi-year plan as they talked about, but I think investors want to see a little bit more concrete data, concrete thoughts on exactly how they're going to monetize some of these non-core areas.
So that having been said, Aaron, about, listen, we got tax issues, expenses, CapEx. Having said that, you remain bullish on their name. You tell clients this one's a buy. What are the catalysts ahead that you see here?
Yeah, no, still expect continued strong revenue growth. Obviously, another quarter of 20% plus ad growth we saw in Q3. Q4 guide implies another 20% growth. We think it can grow mid-teens top line growth for advertising in 2026. And we think valuation is still undemanding. It does get a little bit more expensive if you look at it on a free cash flow basis, given that CapEx spend. So I think that's maybe where investors have a little bit of hesitancy. But on our GAAP earnings basis, we think we had them doing around $30 of GAAP earnings in 2026, so fairly reasonable valuation given their growth rates.
Some earnings movers this morning, we're tracking Eli Lilly, Merck, and Comcast. First up, Eli Lilly shares are jumping in pre-market trade after the drug maker raised its full-year revenue outlook. The company now sees sales between $63 billion and $63.5 billion. That's up from a prior range of $60 to $62 billion. Full-year adjusted earnings guidance was also raised to between $23 and $23.70 a share. Lilly citing strong volume growth from its Mounjaro and Zepbound drugs, both key GLP-1 treatments driving its surge in demand. Next up, Merck. Shares are down despite the company beating expectations on both revenue and earnings. The drug maker narrowed its full-year sales forecast to between $64.5 and $65 billion, compared with its previous range of $64.3 to $65.3 billion. The company also noted a modest negative impact to Keytruda sales this quarter, attributing that to wholesaler timing. And finally, Comcast, shares rising about 1% after the company showed signs of stabilization in its broadband business. The cable giant lost 104,000 domestic broadband customers, but that was better than expected. Analysts have been looking for losses of about 140,000. Revenue did come in ahead of estimates at $31.2 billion versus the expected $30.7 billion, while adjusted earnings per share came in at $1.12, also topping forecast of $1.10. Well, that'll do it for Market Sunrise. I'm Allie Canal. Thanks so much for watching. Julie Hyman has you on the other side with Morning Brief.